G'day and welcome to this week's video. My name is Robert Gowdy, and this week I thought it'd be well worthwhile, given the coronavirus-inspired share market crash, that we look at some of the tools that we use to help ascertain valuations of the market. And we've used this over many times, not just in a crash environment, but at a time where the market is becoming expensive as well, and we may be choosing to not buy as much and build up cash reserves. So we'll just go and share the screen very quickly. And this is research from Tim Farrelly, and what you can see is up around here, these are 10-year forecasts. So what Tim's saying when he's doing a 10-year forecast is we don't know in the short term what the market's going to do, either 1 month, 6 months, 1 year, couple of years. We really don't know what's going to happen. But over a 10-year time frame, things become more predictable. Earnings, earnings growth can be a nice even percentage. In the short term, we know the share markets do that. So when we're talking over a longer time frame, Tim's been successfully been able to give us a guide as to what valuations we might expect. Now, he takes three considerations when he's doing that, and part of what he does is thinks about the dividends. So that is a clear percentage. So dividends, earnings growth, and also the P ratios. So those P ratios are really is a ratio where how much will an investor pay for $1 worth of earnings. So if the average is sort of 16, 17 times, so $1 of profit or earnings, investors are prepared to pay $16 or $17. Now that's the average. It shoots well above that and it shoots well below that. At the moment, we're more than likely well below that as investors become pessimistic and less inclined to continue to invest into the market. When it goes above that, people are feeling optimistic and are happy to pay more for their investments. So at the moment, we're probably sitting around 5,300, and as you can see here, that we're just going to get the mouse right. Around these figures, we're sort of going to expect between 10 and 11% or thereabouts on average for the next 10 years. So you can see from Tim's research, and he does it for Aussie equities, developed markets, and so on, that the further the market goes up in value, our future expected return starts to go down the further we go up. And as the share market goes down, like we've seen, our future expected return starts to go up. So whilst Tim and all financial advisors will make no comment about short-term movements or what it may do, we have no idea. But longer term, this can be a really good guide for us. And Tim's been running this service for well over 10 years and has been extremely accurate in this space for quite some time. So green is go, it means cheap. So yeah, this can help be your guide. And I'd highly recommend that you speak to your financial advisor with regards to this type of information and to make sure that you're taking advantage of the markets. Now, I've been mentioning quite a lot previously that reasonable time to buy, and we've been progressively doing so for our clients. But not everyone's like Warren Buffett, who has cash set aside ready to invest. So in the next video, I'll cover off the way that if you haven't got money set aside, where investors can take advantage utilising their superannuation and retirement assets, how we'll look at the asset allocation, the risk profile, and how that might be changed slightly to take advantage of what's happening at the moment. Thank you for listening. Really appreciate your time, and we'll catch you next time. Cheers. Bye.